Today, we're breaking down the risk and the rewards of high yield income ETFs like JEPI, SCHD, and YieldMax, and other synthetic dividend ETFs. Some promising yields over 60%.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A, and Relative Strength Manage Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Hi again, everyone, and welcome to Leibel on Fire. I'm Freddie Bell, and joining me is Amazon's best-selling author of Living with Financial Anxiety and also the book Authenticity. Hello, Leibel Sternbach. It's so good to see you again.
Hey, how are you doing today?
I'm doing well. We've got a lot of letters. We have a lot of alphabets today, and I'm hoping you can break them all down for us. So let's start basic and work our way up. What do ETFs like SCHD, JEPI, and YieldMax ETFs work? How do they work?
All of these ETFs, the reason why people purchase them is because they want the distribution. So Schwab has this high yield dividend ETF, SCHD. What they do is they look for companies that pay really large dividends and they package it up into an ETF. So instead of you going out and finding all of these companies that pay high yield dividends, they put it together for you and you just buy the ETF. And people really like that, right? Because you get the equity exposure, market goes up, it goes up. But on top of that, instead of just getting whatever dividends you get from the market, you're getting more dividends than usual. So if you're a dividend investor, if you're somebody who likes living off of the interest of your portfolio, then it's a decent option, right? Because you're getting more yield than you would get from just holding the market. You don't have to go shopping around for that yield. And you have a certain level of diversification because you have all of these different companies that you're getting the yield from. So let's start kind of on a risk spectrum. That's the lowest risk possible, right? Because in terms of yield or dividend investing, you've got a very large basket of diverse stocks that you're getting this yield on. So that starts at the beginning. Next, you have people started asking the question, but what if I want more? What if I want more? And this really kind of blew up during COVID because during COVID, people were sitting at home all day and the market was really volatile. And so they started asking themselves this question of, can I day trade? And people started trading options. Now, options are very interesting because options allow you to do two things at the same time. So number one is you have the ability to, with a very small amount of money, control a very large portion of the market. So you can, let's say, put down $100 and control $1,000 worth of stock. And it's because what you're buying, you're not buying the stock itself, you're buying a contract that gives you the right to buy or the right to sell the stock at a later date. By itself, what it allowed people to do was to use a very small amount of money to make a huge amount of money. Because if you bet on the direction of the market the right way, right, then all of a sudden you get to put down a $100 bet and you get paid $1,000 or you get paid $10,000. So that is what happens with options. What some people started doing was like, okay, well, if I can get myself contracts that will pay on buying or selling, then what happens if I own these stocks, right? All these dividend paying stocks, and I sell to other people the right to buy my stocks. Now they're paying me income for the right to buy it. And I sell it at a rate, I sell it for a price of, let's say the market goes down by 25%. So will the market go down by 25%? Very unlikely event, right? It happens, but it doesn't happen very often. So the probability of me just getting the income for free is very high. Right? And so people started doing that, right? They started selling these income options where they're just doing it for income. And they started taking that high yield dividend stocks and they went from a 7, 8, 9% yield to 10, 12, 15% because they're selling these options. In comes JP Morgan and says, you know what? We can give you an ETF that does that, right? And they created JEPI, JEPQ, which one's on the S&P 500, one's on the NASDAQ. They got their institutional risk management in there. So the chances of it going down to 100% or you losing all your money, right, is a lot lower. You don't get as much upside, but they're managing these options. They're managing the underlying portfolio and you're getting a decent return.
It sounds almost like magic that you can get 100 times on your investment. So how are these ETFs able to produce 10, 20, even 100% like as you've just outlined?
So remember, in the market, risk is commensurate with reward, right? Or reward is commensurate with the risk, right? So if you're getting a 10, 20, 30, 50% return, you are taking on a certain amount of risk, right? If the market usually returns an average of 10% a year, and remember that's averaging out with the pluses and the minuses, but if you're getting on average 10%, well, guess what? If you're all of a sudden doubling that or tripling that or getting 100% return, you must be taking on an incredible amount of risk. So
that follows.
In comes these companies like YieldMax. YieldMax, I think, was the first to do it as an ETF. YieldMax was started by a guy that I know, Jay Pasquale, who was an options manager, and he has a company called Zega Financial. They manage options primarily for financial advisors, for us on our clients. But he launched a suite of ETFs. I think he's got like 70 at last count. And what these are the complete opposite of diversification, where you have Schwab's high yield dividend ETF and you have JP Morgan with their option income ETFs, where they're really trying to diversify and reduce the drawdown, reduce the probability of going to zero. YieldMax takes the opposite approach, and they basically say, let's take this thing that all these individual investors are doing, where they're selling these kind of extreme options or buying these extreme options, and let's just manage it professionally, right? We're not going to worry about potentially having an 80% loss, because we're okay having an 80% loss as long as most of the time we get insane growth. And so what they do is essentially they do these options where they're not necessarily limiting their downside exposure, but they're mainly going for that income premium. They're going for, we are going to sell options that have a 99% chance of expiring worthless, but on that 1% or 10% chance that they don't expire worthless, we're going to have to fork over quite a bit of money. And in return for essentially allowing more responsible people in the market to hedge their bets, they get paid a very nice, healthy premium. And it can produce quite insane returns.
Leibel, I'm wondering, with all these returns you were talking about up to 100%, are these yields really sustainable? Can you actually get them?
Can you actually get them? Yes, you can absolutely actually get these returns. The question is whether they're sustainable and whether you're eroding principal in order to get them, right? So that always becomes the question. And when you look at the total return, when you look at, okay, I'm getting a distribution of 20% or 50% or 100%, am I getting that and I'm not losing my principal at the same time? And it's a dicey question. The other question, the more sophisticated question to ask yourself is, in getting my returns this way, am I foregoing other returns that would have been comparable? And I'll explain that in a second, but let's go back to, is it sustainable? The greater that distribution rate is, the less likely it is to be sustainable long-term, or more likely, even if they can sustain that distribution rate, the question would be long-term, right? Will they be able to sustain those rates over the long run? And I don't know the answer to that question, right? Because you have this market volatility, right? The only reason why they get these distribution rates is because there's volatility. And so therefore the option pricing is all over the map, which I think there's a certain amount that's going to keep up, because you have, just for comparison, 10 years ago, 98% of the stock market was controlled by institutional investors. Now it's only 60%. Which means that you have a lot more volatility in the market just because the players who are in the market are not as disciplined. They're not pension funds. They're not endowments. They're not mega corporations. They're Johnny on the spot, literally on his toilet, trading options, right? That's who's moving the market right now. And that means volatility. So do I think that there's a potential for these yields to stay sustainably? I do think that it is. However, there's also extreme volatility, because in order to get those extreme yields, they're doing it on single stocks, right? And so if you're doing it on a single stock, you got to do it on something that has volatility. So something like Tesla or Nvidia or Microsoft or Apple, where the price moves a lot. So therefore you can get that option play. Yeah, and I've seen days where they've been down 80%, right? So if the stock itself is down 80%, the options could potentially go to zero, right? Or it can go as close to zero as possible, which if you have 100% loss, you need a 200% gain to get it back. So is it sustainable in the long run? I don't know. We're entering into uncharted territory. I would not bank your retirement dollars on this. I would not bank your income on this. I do think when you look at the kind of the spectrum of risk, you have things like JEPI and JEPQ, which I do hold in my ETF. I hold in my client accounts because I think that those are done in a very sustainable, very conservative way of generating that type of income. I think this type of income is a new type of asset class that needs to be incorporated in portfolios, just like you have cryptocurrency needs to be incorporated in portfolios. But at the same time, I think the extreme version of it is an extreme version of it. Can you make a whole lot of money off of it? Absolutely. Can you lose your shirt off of it? Absolutely. So
in a nutshell, it's too volatile to really trust in. Is that what you're saying?
It's too volatile to put all your eggs in one basket. I think that if you wanted to dabble in it and put a few percentage points, that you want to put 2-3% of your net worth into something like that, absolutely go for it. Yeah, as long as you understand that your money can disappear. And as long as you're okay going it to zero, then go for it.
Makes a lot of sense. We're talking with Leibel Sternbach about downsides of high yield income ETFs. So finally, what should investors consider before buying one of these covered call ETFs, Leibel?
I think the first thing that you need to understand with these option strategies is that they are based on the option pricing. And they are based on that the market isn't going to make a huge move in any given day, right? And so if the market has a huge move or it has an unexpected move, then all of a sudden you can lose all your money. And that is something that's very important to understand, is you are very much exposing yourself to a possibility that happens with some kind of regularity, right? A 5% day, a 10% day, you kind of need to know where that range is. You have to also understand that as these ETFs get more assets in them, as they grow and they become more successful, that actually hurts their ability to succeed. It hurts their ability to give the returns that they have given up until now, because in order to get the options to be able to pay out, there aren't enough participants who are going to take the other side of that contract. And so it becomes very difficult as it scales to get those same types of returns. So keep that in mind. There is a place for it. It is not all the rage that it's built up to be.
I understand. Tell us what we can find at yieldsforyou.com before we go.
So yieldsforyou.com, we've got lots of tools when it comes to retirement. If you've got a portfolio you want us to take a look at, request a pre-retirement tax SWOT analysis, more than happy to take a look at that for you. And if you would like to talk to us about where this fits into your portfolio, again, more than happy to have a chat, or you can go and hire us directly through our ETF, right? Like that's a free way to hire me because we use that as a small percentage in that strategy as well.
The website is yieldsforyou.com, yields, the number 4, the letter U.com. And I want to thank you, Leibel, and also thank you for joining us today as we broke down the risk and the rewards of high yield income ETFs. Big yields can be tempting, as Leibel told us, but understanding the strategy behind them is key in making smart retirement decisions. Stick with us for more insights to help you to retire with more clarity and with confidence.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.